What's going on, everybody? Michael Silva here. Welcome to another episode of the Stock Market Brief Show. Today's episode is a weekly recap. Okay, we're going to go over what took place last week. We're going to look at weekly charts and some stock market indicators, get a good idea as to what to expect going into next week. Now, we saw volatility pick up early in the week, and then all of a sudden it subsided and the market continued to bounce. And we're going to be looking at some interesting charts, some sectors today. Big economic news coming out next week. Not really big economic news. We don't know what the news is, but the Federal Reserve was going to have its Jackson Hole meeting. It's no longer going to be at Jackson Hole. They are moving it because of Delta concerns to online. And if you want to hear the Federal Reserve, Jerome Powell's remarks, you can watch that live streamed on the Kansas City Fed's YouTube channel at 9 a.m. CT or 10 a.m. ET on August 27th. Let's hop into today's show. All right, everybody, welcome back to the computer. First thing I want to call out, this is the weekly performance of the 11 sectors that make up the SP 500. Energy taking it on the chin. Big time, down 7% for the week. That is a huge move to the downside. Perhaps an opportunity there. Well, we'll get into those charts here shortly. The leaders, take a look at the leaders. XLU, XLV, XLRE, pretty defensive sectors leading the way for the S&P 500. If we take a look at a relative rotation graph, you can see here the leading quadrant. We have both XLV and then technology leading the way. So those can be some of the stronger sectors. And we saw a big pickup in the Qs as well as various tech stocks. For example, Microsoft really had a huge week last week. We saw NVIDIA, a semiconductor name, pick up, and then we also saw some healthcare names to pick up as well. You see some improving sectors right over here, XLY and XLU. XLY is an interesting one. We'll get into that a little bit more, but really what makes up the XLY, it's really just three names that make up around 50% of it: Amazon, Tesla, and Home Depot. I think Amazon's around 21 to 22% weight. Tesla's around 13 to 14%, and then Home Depot is almost 10% of a weighting. What took place in the bond market? Let's take a look at yields. We were watching this spike in the yields, and then it subsided back down. We'll see here what wants to follow through, if we want to see more momentum to the downside or not. This is the 10-year and 30-year. What I did find interesting is if you look at the 5 and the 30 spread, that actually flattened out. It actually broke down from a previous area right here. And that right there, when we see these breakdowns take place or the curve flattening like this, it's typically not the greatest for financials. And we just had, this could be temporary. It might revert back up, but this could be also something really close to pay attention to. As you can see, these short-term yields are actually rising. You can see here the 3-year and then the 5-year, and then the 10-year sinking down, and then also the 30-year pointed down this last previous week too. So something to keep an eye on. The TLT is looking rather bullish here, so it's going to be interesting to see what plays on to next week. We were talking about this on the previous episode, how we're looking at the change in trend, how the 50-day moving average, you can see it bounce, then rejected, bounce, rejected, bounce, rejected, headed lower, and then finally now we're starting to pick up where we use the 50-day moving average as a level of support. The PPO crossed over to bullish, and it looks honestly like it wants to start heading higher. If we look at the TLT from a weekly perspective, you can see here the weekly 5 EMA did hold as support, and we're right there at the upper range. You can see on-bounds volume picking up, and the price percent oscillator does look like it wants to cross through that zero line, which is bullish to see for TLT. Financials. Now, this is interesting because if you start to see bonds rise, typically what you'll see is financials lag. Now, financials didn't have the greatest week, down 2.31%, but look where they got bid right back up to the 5 weekly moving average. The PPO is bearish crossover. This, to me, I don't think financials are going to play a huge part in next week's performance. It doesn't seem like that, but who's to say what could potentially happen after we hear Jerome Powell speak? Now, when financials do bad, you typically, want to take a look at energy. They sometimes move hand in hand together, and energy took just a huge hit, down 7.14%. Now, if you remember this chart, this is right where our band of support is. So when I said, hey, this could be a potential opportunity here, well, I'm looking at it from a risk versus reward perspective. As you can see, there's previous resistance, and previous support, and we're coming right down in that area on a large aggressive candle. When we get these rubber band type candles, this isn't where you really would want to short. It's potentially where you'd want to go long. Now, yeah, it could break down and continue to break down, but what you'd like to see for a breakdown would be a large range candle, and then to maybe go sideways a little bit, build up some, just coil up a little bit before it falls down further. Sometimes these rubber band moves into areas of support. They can bounce significantly from there. Now, overall, when you look at the daily time frame, which I don't have in front of me, the trend is getting pretty bearish. You could potentially, from a weekly perspective, call this a little head and shoulders. We'll watch for the breakdown of this 45 level. And not energy, oil, WTIC, you can see here has been just falling right through this area of support, and it does look like it's going to be heading down to 60. So if oil gets down to this 60 level, I would imagine this aggressive of a move can see some sort of just like melting rally, like a very strong rally that we've seen, like for example here, a big strong move to the downside followed through by a really strong rally, and then it died down deeper. You can see here a high, lower high, a low, and a lower low. Okay, so the trend is changing here. It's going to take a lot to repair this, so we're going to continue to monitor this. It doesn't mean that there's no opportunities, right? So energy sector, like I said, if you hop into XLE, you might catch a run up, for $5. For example, like if it bounces from 45 and comes up to 50 or retags the weekly 20 simple moving average right here, that can act as, that's a really good play from a risk to reward standpoint. So it's something to watch for. Another chart that we've been paying attention to is the dollar. Now the dollar did tag the upper weekly Bollinger Band perfectly, and then it started heading a little bit lower. So there is some resistance up ahead. It did close the week at a pretty significant high. It hasn't been this high. It's a high for 2021, closed at that high. And we got above this previous area of resistance, and we're still broken out of this inverse head and shoulders. Now, from the daily perspective and the weekly perspective, hitting this upper Bollinger Band, it could act as an area of resistance. Now, if you really pay attention, if you really pay attention on the daily time frame, which I don't have here, is the move that it took to get here, it hasn't digested that kind of a gain yet as it broke out. So it's something to be mindful of, that we might see some weakness first or digesting before it could potentially try to reach higher. So that is something also one just to be mindful of, which means potentially we might see a bounce in the miners, we might see a bounce in gold. Miners have been getting hit very, very hard, and if the dollar starts falling over, it could be beneficial for the miners. If I just pull up the GDX on the weekly time frame, it was down 6%, and look at it closed at that lower Bollinger Band below the 5 weekly moving average here too. The price percent oscillator is very bearish, so this is trending down and is right at this previous area of support, right at just above $30, so $30.50, let's call it. Okay, what did we close at? $30.85. So yeah, I'd say $30.50. This might see an aggressive move to the downside, but just be mindful for a potential bounce, especially if the dollar actually starts falling over. If the dollar starts rolling down, that could be beneficial to commodities like energy, like miners, etc. And if I take a look at the BPGDM, look here, this is reading at 30. If it gets down into 25, this is like the buy zone for miners. So be mindful that if this thing starts getting down here and it gets oversold on the RSI, it might present itself an opportunity for some of the miners. Now, gold itself hasn't been doing anything for this last week of trading, right? We had this big aggressive move to the downside, and it quickly reverted right back. We still have some work to do. We need to get above 1840 to make sure that this bounce isn't just temporary right here. 1840 would give us through this resistance and back above these moving averages. It would give a little bit more confidence to the gold bulls. Another chart that I want to pay close attention to is the VIX, right? We saw this volatility really increase early in the week, and then it just fell right back into the center of these, the Bollinger Bands. Now, think of the Bollinger Bands, you can think of it as standard deviations, right? It goes two standard deviations in both directions of the 20-period moving average. So when it gets way extended, you can typically see it revert back into the mean, and that's exactly what took place. Sometimes when the Bollinger Bands get tightly contracted, this is when Bollinger Band squeezes take place, and we've been watching for that Bollinger Band squeeze, and that looked like it was going to happen. And it also signals that, okay, if we start seeing an uptick here in volatility, that traders and potentially hedge funds, etc., might be more willing to go risk off into other positions. Like we've already previously seen, the defensive sectors really held their ground last week, especially during that spike of volatility. Okay, XLY. Let's talk about XLY. XLY to me, it's looking more bearish. Although it's not far from its all-time high, right? So it came down past the 20 weekly moving average, and it bid right back up, acting as a level of support. So this to me says, okay, yeah, we can go tag this upper Bollinger Band again, and we might have another area of resistance. The upper Bollinger Band is right at 185.50. Now, like I said, XLY, it's really, there's three top stocks there. It's Amazon, Tesla, Home Depot. If you want to go more down the list, you can look at Nike and McDonald's. Those, Nike and McDonald's make up for around 10%. But Amazon is like 21% weight. And Amazon has been getting ripped. However, if you take a look at Amazon chart right now, just look at how tightly coiled this falling wedge is. This thing looks like it wants to take somewhat of a dead cat bounce here. We're oversold on the RSI. The PPO is starting to curl itself over. Have a little bit of a hammer candle here. It's like if we start getting above this 3250, there's no reason why we can't go try to tag this 20-day moving average, or even come right around the 3400. That would be at level of resistance that would probably, hang up and then either one, try to head higher or continue to break down. But this also pulled down sharply into a previous area of support that we've seen some pretty big moves from. So if Amazon starts taking off, I mean, that's going to make a big difference for the consumer discretionaries. Now, one thing that I have been noticing is if you pull up the volume advanced decline cumulative line here, this has been heading lower, right? Lower highs, lower lows. Meanwhile, XLY keeps trucking up, okay? This right here is a negative divergence, and it's going to have to resolve in some sort of way. And that's either through a breadth thrust to the upside, or the XLY is going to catch to the downside. So that is something to be very mindful of, and why it's important to pay attention to risk and reward trades. Now, if I look at XLY over XLP, this is looking at, the needs versus the wants. That's just the easy way to break it down, right? So consumer discretionary is made up of the wants, like, Tesla, right? Certain things at Target, just, etc. XLP is consumer staples, the necessities that you need in everyday life. As you can see, when this chart goes down, that means consumer staples is going to outperform XLY, which is the consumer discretionary, and this has been heading lower. Now we're pulling into a previous area of support, and that tells me that we can potentially bounce from that area. And looking at stuff like Amazon, being so, oversold, going into next week, we might see this bounce. That would make sense. Now, if we see continued weakness throughout the various holdings of consumer discretionary, like if Tesla all of a sudden starts getting hit hard, which makes up for around 14%, if Home Depot had an amazing day on Friday, so I feel like we can potentially see some follow through. It tells me that consumer discretionary might catch some sort of bid into next week, and the defensive sectors that were winning this week might take a little bit of a breather. Okay, so that's a very strong possibility heading into next week. Now, one other thing that I want to pay attention to is XLP over SPY. Now, this XLP has recently been outperforming the SPY. Its relative line right here is rather flat, so it's still not quite there yet. However, I am still paying attention to the positive divergence building here and this rate of change positive divergence right here. And last time we've seen these positive divergences play out, we see the XLP on a relative basis outperform the SPY quite significantly. So what would make me think, okay, consumer staples, this is the time? I would say let's watch for the rate of change to cross through zero. If it crosses through zero, that means the rate of change between this relative performance, it means that XLP is really starting to pick up some pace here. If it crosses through zero, I would imagine we'd be getting back above this 0.17 and higher. So that is what I'm paying attention to going into next week and the following weeks up ahead. Now let's look at the charts on a weekly performance. We'll start with the S&P 500. You can see here a little bit of a hammer candle taking place. We're pinned just right there, just grinding higher on the upper Bollinger Band. It's clearly acting as an area of resistance. And look where the price brought us right back up to, right to the weekly 5 EMA. It's almost just algorithmic. It comes right down, and then we get bid right back up to the weekly 5 EMA. The 20-week moving average is at 4278, so that is an area to watch out for a potential area of support if we do see some weakness going into next week. Price percent oscillator is still bearish. It's it's losing momentum, it's lacking. However, on balance volume is just trucking upwards too as well. So this to me, it's a bullish chart. It's just bullish all across the board here. NASDAQ 100, a lot of indecision. Look at just a pretty wide range candle. I mean, it's hard to see because it's a logarithmic chart right here. But you can see here minus 44.11. It was down 0.29% for the week, but it was significantly more down. But towards the end of the week, we had a bid back up. That's a lot of small range candles right here, which means, hey, there's a lot of indecision taking place. Do we want to head higher? Do we not? And when you take a look at this small range candle, look where also it bid right back up to the weekly 5 EMA. So until the bears gain hold of that, we might not see another stronger move to the downside. We haven't seen a 5% correction since last year. It's been quite some time. If you look at semiconductors these last couple of weeks have been getting hit hard, and they make up for a big portion of the NASDAQ composite, down 2.31% this last week. And look where we bounced, the middle range of this band, the 20 period weekly moving average. This to me is significant because looking at like other charts, like the 15-minute time frame, it actually looks like it's start breaking out of its 5-day moving average, and it looks like it has the potential to get some legs to it. So if you are part of the Discord group, you probably noticed that I'm posting a few charts that have semiconductors because they are looking like they could very well benefit if we get some momentum to the upside. As you look at the PPO, it's still bearish and it's crossing down, but the histogram is starting to pick up here. On balance volume is still strong too. Also to note, the Bollinger Bands have been really tightly contracted here. They've been tightly contracted, not on the NASDAQ 100 as much, but you can see on the S&P 500, it's been picking up there too as well. So let's continue on. Dow Jones Industrial Average. Look at how tight these Bollinger Bands are contracted. Look where the price came down to. 20-week moving average. Where did it get bid right back up to? The 5-period weekly moving average. Frequently tagged moving average, but it's just interesting to see that the bulls just bring it right back up to that level. Bollinger Bands being so tightly contracted, contractions lead to expansions. That is no directional bias. That can be bullish, it can be bearish. Okay, but typically when you get that break, it's somewhat of a significant move. Price percent oscillator, it's oscillating, it's pointing downwards. So that's bearish, but it is above zero. And if you take a look at on balance volume, we're still trucking up. So on balance volume matches the price action here. No divergence that I can see. Transports make up for a big portion of the for the Dow Jones composite. And it's important to watch both industrials and transports if you follow Dow theory. Now, this one actually does look like it's breaking down here from this previous right here in May. We've been diverging from the industrials. And we closed below the 5 weekly moving average. We're below the 20 period weekly moving average, and we've been below it for 1, 2, 3, 4, 5, 6, 7 weeks now. The Bollinger Bands are really tightly contracted, but as you can see, when we had this red candle to the downside, it got bid right back up, and then we saw one more week worth of weakness right here, minus 2.5%. Price percent oscillator is also bearish, but the histogram's picking up. On balance volume is pretty flat right here too as well. So to me, this signals like we're going to see some big moves here soon in various indices, various sectors, and then also potentially here the transports. The RSI also is just floating right above 50 right here at 51.31. So we'll continue to see what happens here. I think that we can see a nice little pop if we get above 15,000 in the transports, even to the point where we go retest the upper Bollinger Band, and that's right at around 16,000. So that's something to watch out for. But as it stands right now, we're not close, right? We have a lot more work to do for the bulls. IWM. Now this to me is pretty darn crazy, as IWM has been seeing some more significant weakness, and you can see here the Bollinger Bands. Just look at how tightly contracted these are on a weekly perspective. RSI is below 50. Price percent oscillator is completely heading down. On balance volume is matching that move to the downside. Now, we were outside of the Bollinger Bands, but look, we got bid right back up into the lower Bollinger Band, and we saw some strength at the end of the week, right? But that's, that's fine. You typically see that, especially if we're going through a 5 or 10% move. 10% would be considered a correction. 5% would be, I guess, there's a pullback. But you typically see, we've been seeing, a move to the downside and then a big rip to the upside. So are we going to see continued movement to the downside? I wouldn't be shocked if we get a little bit of a bump to around 220 and then maybe head lower. But right now, as it stands, if financials don't perform going into next week, which to me, it doesn't seem like they're going to be that much of a standout. It looks to me like most people are going to be focusing on the bigger names. Like Microsoft is like 2 or 3 standard deviations outside of its Bollinger Band, or 3. It's basically, 3 standard deviations from its normal average price of the 20-day moving average. If you look at the Bollinger Bands on the daily time frame, it's completely outside of it. So I would imagine that's right around 3 standard deviations from its normal move. And that's a very, 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 very strong move. And then you look at Cisco. If you look at, Home Depot made a big move, right? There's going to be more focus, in my opinion, on various tech stocks going into next week than there will be on financials. I could be wrong, but that's just kind of what it's looking like so far. FXI. This is China. I just wanted to bring this up here because there's been just a lot of just complete destruction in China large cap ETF. You can see here a high of $54, and now we closed at just under $39. That's a big move to the downside, and the markets aren't really responding negatively at all to this. We're still floating around all-time highs, and China has somewhat of a negative correlation sometimes. I think that the DAX the German DAX, they correlate more appropriately to the United States. However, these type of moves, they can affect our United States market. So like the SP 500, the Dow Jones, all these various markets, and we haven't seen any reaction or really anything really about this. And that to me is it's just something to be very mindful of, because this is bear market, completely bear market now. It is very extended past that lower Bollinger Band. We're below the weekly 5 EMA. We're below the 20. Yeah, we can bounce, but this is just breaking down, lower highs, lower lows. It just doesn't look good at all. Let's look at a couple indicators right now. Let's take a look at sentiment. So sentiment, we're looking at asset managers and the RIDEX. Asset managers, they backed off a little bit. Okay, so, but it's still not like crazy to the downside. So it's 70.57 is the reading. It can go above 100. It means you're using leverage, fully bull mode. And then the RIDEX here is backed off just a little bit, but it's still pretty darn bull mode here too as well. So yeah, a little bit of a downtick, a little bit more bearish sentiment, but nothing too crazy to report there. If you start to look at the AAII bulls to bears ratio or the surveys, what I did find interesting here is the ratio took quite a bit of a nosedive. And you can see here it's diverging from the price action too as well. And we've diverged from the price action before, and it's led to drop-offs in the market. You don't need to put too much weight on anything like that, but once these readings get too overextended, sometimes I like to take a contrarian standpoint. So, if these go deeper, but yet price action is still up high, sometimes that's more of a bullish thing that you can read into. But we'll see, because the divergence has played out before to the downside. Just note that sentiment, it's kind of fading a little bit here from the bullish perspective and getting a little bit more bearish according to the AAII bull and bear surveys. Now, the NYSE McClellan Summation Index, this crossed below 0. Now it's starting to, you got to start to pay attention to this. When we cross through 0 before, we can bounce from those levels. But when we get real, significant crosses through 0, we've seen some significant selling. And I just want to call out, it is now below 0, minus 7.75. So we're in a little bit of a danger zone here. However, for example, when we pulled right down in that area previously, we were already from a pretty significant, I think that was a 10% correction. And then we saw this big rally. We didn't even get a 5% correction, and we're back here at 0. So this little big move there on Friday, Thursday, Friday sort of move, maybe that's a fake out to head lower, and this heads lower too as well. The price action has been diverging from the summation index. However, what you could also think of is if this starts to turn up, I mean, that could give us one big breath thrust to see some sort of crazy melt up, especially if all of a sudden various stocks that haven't been in play start to play, right? We've been looking at the percent of stocks above the 50-day moving average, above the 200-day moving average, how they've been just getting beaten up. There's this stealth bear market, and the market is going to respond eventually, whether it's going to catch to the downside or we're going to see a big breath thrust to the upside. We don't know. We just need to be prepared for when the move takes place. If you're long a bunch of stocks, you're going to really benefit if we get a breath thrust to the upside. But if you're long a bunch of stocks and all of a sudden the indices catch down further, then you want to just be prepared to, exit a position or hedge in that environment. Look at the NYMOT. This is the NYSE McClellan oscillator. This, I was thinking that if we get down to this 300, then, and the NYSE summation index is also below zero, Tim Orr did some really cool research and showed some charts on, that elevates the risk profile where we can see even more significant sell-offs. But we also mentioned that these levels right here also are pretty overextended and you could get bounces, and we bounced from that level. So we'll see here if it's going to turn back around or if we're going to continue to see that bounce to the upside. All right, everybody, let's wrap up some kind of thoughts going into next week. There's a lot going on, right? So first off, what I want to call out is the first indicator that kind of has me on edge going into next week is the summation index crossing through zero. So that's something that we be mindful of. Another thing to watch out for is just the really tightness of the Bollinger Band showing up on the weekly time frame. Okay, contraction, it leads to some sort of expansion, whether that's to the upside or downside, we don't know yet. Okay, so be mindful that in the week to come, we can see more increased volatility. We can see stronger swings. This last week, we got a good glimpse. Okay, we got a good glimpse of crazy moves, right? Big gap up and then reverted right back down to the downside. Then we get a gap down and then it rips up to the upside. So it's a lot of chop taking place. Okay, to me, I think that we might be seeing some sort of bounce in consumer discretionary stocks. So, for example, Amazon would be one of them. If we don't, it is what it is. But this, to me, looks like it's coiling up to make some sort of move as it's getting in this oversold territory. Could be a dead cat bounce, but a stock like this can really help move a market. So if you look at this type of stock and then you pair that with some huge moves made in various tech stocks and semiconductor stocks like NVIDIA, it seems to me like the market is getting ready for a larger move in various names, and the various names that are showing the strength are the ones that have been holding up the market. Okay, so be mindful of where all these individual names stand and just find quality risk to reward setups. Me personally, like Amazon, for example, if it starts breaking out or getting above the 5-day moving average or 5-day EMA, you can enter in and then you have a stop loss below this previous swing low, right? That would make sense to me from an Amazon perspective. If you don't trade this behemoth of a stock, there's also option strategies that you can use too as well. Like I said, you just need to be very careful in this environment. So going into next week, I'll be focused in on semiconductors, a few consumer discretionary names, and then also healthcare names because of that relative rotation graph. That's all I got for you on today's episode, everybody. Hope you have a wonderful weekend.